All right, guys, in today's short, we're going to talk about the P-shaped profiles, the two main ways you can look to trade them, and also a little bit about vertical distributions, which is one of the main ways that these P-shapes typically develop into. So with a P-shaped profile, what's basically happening is you have a long lower tail that has very low value, and you have a upper POC node towards the high that has the bulk of the value, and then you basically have no upper tail. Now, typically these are created when the pre-market is trading very one-directionally. Now, with most P shapes, you want this to be a move that is pushing higher. So you want to start from the low and then push up. You could also have a P shape where you started from the high kind of as a D shape, and then you started to fail and create that lower tail. That is not the type of P shape we will be talking about today. Okay, so for these bullish P shapes, there are two main ways you can look to trade them. The first way is the bullish way, where the upper node, the value area high, value area low are being protected by the buyers, and price is just slowly climbing higher the entire day. That initial trend from the pre-market is still being protected as the open is happening, right? 9:30, 10 o'clock on the open. The buyers are still protecting that open. So if we go down to the lower time frame, typically what happens if that open is being protected is a vertical distribution. And this is exactly what a vertical distribution looks like. You have the open, you start to trend up, but on the lower time frames, like the 1 minute, the 5 minute, it is very sloppy. It's very choppy. You have this uptrend, but look at the candles. The candles are just not really going in one direction. They're not very strong in one direction. They like to pull back quite a bit to the 1 minute lows, the 5 minute lows. Now, typically, this will be pulling back to the 8 EMA or the 24 EMA, which I can't get into in this short. Watch my longer video on that. So the first way is a vertical distribution. Once again, watch my video on how to trade vertical distributions. The other way is an overnight fade. If you start to trade below that value low, the buyers are not protecting those upper levels. You look for the overnight low to be tested. So the value area low is lost. Value begins to build below that value low, and then you push down to that overnight low, basically reversing the entire pre-market trend.